Welcome to today's webinar. My name is Michael Mandarino, founder of 123 Investing. I want to thank you for taking time out of your day today to explore some of the most advisors don't openly discuss with their clients. How to build tax-free income, tax-free legacy, and multi-generational wealth through properly structured life insurance. Today, we're going to uncover how high income and ultra high net worth families are using strategies that align with the IRS code, not to avoid taxes, but to reposition wealth so it compounds and transfers efficiently, generation after generation. My goal is simple: to give you clarity, confidence, and real world examples you can use to protect and grow your legacy. So here's today's agenda. We're going to be looking at how to understand tax-free retirement, exploring the fundamentals of one of the older investment ideas that are out there, which is life insurance policies. We're going to explore how using loans can help create tax-free income streams. We're going to look at individual case studies. We're also going to look at multi-generational wealth strategies as well. And then ultimately, key insights and looking at helping you chart your legacy. Summarizing some of the core benefits, outline, and some of the action steps moving forward. Here are some important disclosures. Guarantees are not backed by the financial strength of life insurance companies. This presentation is not endorsed by the Social Security Administration. I'm not going to read all these, but there's going to be a lot of hypothetical examples. They're exactly what they are. They're hypotheticals. These are opportunities that will help moving forward. Diversification does not ensure profit or protect against loss of any investment or financial strategies. Life insurance products are not bank deposits, they're not investments, and they're not guaranteed by any bank or federal agency. Policy loans and withdrawals do reduce cash value and death benefit. Unpaid policy loans accrue interest and may result in a taxable event. So today, what if you could increase your capital while lowering your overall household risk? What drew to you today's webinar? Was it you're concerned that where taxes are at now, that most likely they will be higher in the future? Are you concerned about how to give? Are you concerned about outliving your money? Those are all ideas that I'm sure might have brought you to today's webinar. So today we're going to be talking about tax advantage insurance solutions. So this is a hypothetical household portfolio mixture between stocks and bonds. And what we're going to present today is looking at actually adding a tax advantage insurance policy idea and strategy that's intelligently designed life insurance that fits your family situation. I'm going to flip the script. Most folks look online and say, I want to pay the least amount of money for the highest insurance. Some of our strategies, we want to pay the most amount of money for the lowest death benefit. And there's going to be some things we're going to be talking about are the IRS guidelines. So one of the policies we're going to be talking about today is Index Universal Life. They come with interest crediting potential. So what that looks like, it has a floor and it has a cap. So this is a stock market starting in January. It's going to go up and down, up and down, up and down. So same thing would happen in your with your investments. But the difference with the strategy we're going to show today, there is a cap. The cap means that's the most that you're going to be able to make in any given year. So in this example, you can see the cap flattened out while the market still went forward. But the secret of these and what's really made a lot of folks been successful over time is the floor. That means that your money can grow up and down, it moves forward. But let's take a look at what happens when it gets to the bottom. It stays flat. That means there's never a negative output. Now, there is cost of insurance with these ideas, but there's never a negative year. So when we look at the stock market, of course, we have the ups and downs. And those downs, for those who are on the call, I'm sure you remember the down in 2008. And even through the COVID eras, there were some very big downturns in the market. So historically, markets have returned almost 10%. And we're going to be looking today is without dividends, because insurance that we're talking about are only paying interest without dividends. But what does that mean? What does that 0% floor actually make you? So when you estimate market decline that changes investors' average to a 12.32. So that means if we wiped out all the negative returns, that's where the markets would have been returning if you had that 0% floor. So we looked at some of the insurance carriers we looked at is over the last 10 years, our investors in the life insurance policies actually captured 82% of the upside was the actual capped out of these policies. And if we looked at all the years, over 87% actually met the actual cap. What does that mean? So that hypothetical example, if we use just 80%, so that means because of your cap, that you're not going to get all the upside, those high blue lines, you're going to get more of that level, maybe around 8, 9, 10%. But what does that mean for investors? That means that a 12% return that has that zero floor would actually return at an 80%, meaning you would have participated in 80% of the upswing. That would be about a 9.85%. So why tax-free? How is it tax-free? Well, it's all based off of the IRS code. So what happens is when premiums come in, they're paid in various methods, whether they're flexible or not. The cash value growth is based off of the IRS Section 7702. Some of those, I know there's some CPAs on the call. You probably are aware of that, which allows the cash value to accumulate tax deferred, which is potentially linked to either a market or some type of index. Here's the really interesting thing we're going to concentrate on today is those policy loans. Tax-free access based off of Section 72E, which allows you to have tax-free access to your cash. So some of the ideas we're going to show you is that we're going to be able to avoid potential pitfalls that would happen with capital gains like you get with ordinary income. But with the policy loans, we're also going to show you how leverage can work. And I know folks are on a call, we'll discuss that, but we all have used leverage. If you bought a home, you most likely didn't pay for your home in cash. You probably put a little bit of money down, and the rest of it was purchased on leverage. And then ultimately, the reason life insurance, if it's structured properly, it is paid income tax free. That's income tax free to your beneficiaries. So going back to what we talked about is, as long as a death benefit pays, at least $1 pays to your beneficiaries, all the growth inside your policy becomes tax free. So really, life insurance is one of the only areas where your money can grow in two different places. Now, yeah, you can use leverage on your homes. You could use leverage off of your stock market and pay interest, but a policy loan really represents one of the most sophisticated tools out there that are used by the ultra high net worth and high net individuals where they're able to borrow from themselves. And the most important part is that does not stop accumulation of their values. So because you're borrowing the cash value, then withdrawing it, the insurance carrier actually lends you its own money using your life insurance policy as collateral. When the key factor is we're going to ensure that that original cash value remains investing. And guess what? It's still compounding over time, assuming the markets are participating. This really creates a very unique arbitrage opportunity. So life insurance policies and a loan, your cash value continues to earn dividends or interest credits, depending on the type of policy. And it also ensures uninterrupted growth. So right now, if you wrote a check out of your investment account, of course, that's your opportunity cost is lost because you're taking money out of your investments. It no longer has that opportunity to grow. And Warren Buffett always says, I'm buying when everyone else is selling. Well, with life insurance, with that 0% floor, the markets could be down, but guess what? Your policy will never go below zero. So then you can potentially use your policy as leverage. Again, these are very sophisticated tools that you really have to work with professionals to be able to walk through what does that look like. But, using leverage, you can use it for investments, real estate, other business expansion, or even use it for your own income stream later on. So we're going to, as promised, we're going to start taking a look at some case studies. So hopefully these case studies will fit you, but if not, afterwards, feel free to set up a call with me. We're going to go ahead and be able to personalize your investment plan. In fact, for those who want to be answering any questions, feel free to reach out in the chat and use, and my information is there, but feel free to also answer questions inside the Q&A section as well. So I just posted my follow-up information, but let's take a look at this 45-year-old male. His goal is retirement at age was looking on age 60 is what the goal would be. And when we're doing that, one of the main things, the main focus is that we're looking at, and we're looking at some assumptions. The assumption is he has preferred rates. Goal is age 60 or 65. And ultimately, in this individual, he has $75,000 to invest, and he's going to be investing that for 15 years. Total of planned investments, 1.12 million. So initially, that's going to provide a $3.1 million death benefit. The other thing it also does, and that's payable from day one. It also provides access, if you know about the newer life insurance policies, that'll also provide immediate access for long-term care, which statistics show that there's a good chance that most individuals on this call are going to live 16 years, what they consider bad health. We're going to need to have a lot of doctor visits. So, eating up your revenue and income stream could be very difficult sometimes when it comes to hospital bills, especially for those that either dealing with it now or have loved ones that are using it for long-term care as far as the cost of medical bills. But this individual, if so, obviously some of the hypotheticals we used, that there was an insurance policy that was indexing at a 6.58% rate of return. But here's the interesting thing. It's providing revenue, potentially $148,000. Now, is that guaranteed? Absolutely not. It's a hypothetical. The markets have to participate. Loan rates are different. So these are all things, again, these are hypotheticals. When I work with you, I'm going to show you kind of some worst and best case scenarios. But in this case, from age 60 to 90, he invested about 1.1 million, withdrew over $4.6 million. That's about a $3.5 million of capital gains that, because it's life insurance, as long as that death benefit pays, all that is tax-free. So if he actually lived exactly to 90, that death benefit would be on top of that 4.6 million that he withdrew out. So he invested about $1 million. And again, assuming that this was exactly as is, which hypotheticals never are, because there's no way it'll perform exactly as predicted. It'll go up and down, up and down. But in this case, that was almost almost $7 million that they're able to get totally over his lifetime. Now, some of the advantages, let's say he didn't want to retire at 60, he actually wanted to wait to 65. So we went back on that first slide, $148,000. If you waited another 5 years, that wasn't putting in more money. That was just waiting another 5 years. You can see that's going to net about $200,000 of tax-free income per year, with a total income of about $5.2 million. And if there was an accident, vehicle accident, or a health scare, there's also that towards that life insurance policy will be growing from the initial aspect of where we are at. And here we're showing that there's still a $1.5 million tax-free death benefit to his beneficiaries, or for a church or charity nonprofit of his choice. That real key factor of self-funding it yourself is what I talked about earlier, is leverage. He has access to, at age 50, approximately $355,000, $760,000, and $1.5 million at age 60. So, between now and his 55th birthday, I'm sure there's going to be an adjustment in the stock market. So even if he borrowed his money out when everyone else is selling, there's a good opportunity he can also be using leverage. And if he's looking at tax-free income, we would recommend borrowing that out, investing it somewhere, wherever he chooses, but then paying that loan back, because ultimately he's going to want to have that cash-free available later on. We're making some assumptions of a loan rate of a 5.75%. So let's look at another study. This is a hybrid funding model. Now, typically premium financing, for those on the call that have heard about that, it's only really available if you're worth about $7, $8, $9, $10 million. So we've worked with a few carriers actually that actually allow for what we call hybrid funding. So in the first example, we're still on a case study 1, 45-year-old. He only has 5 years to invest, but he's going to use a lender to be investing alongside him for the first 5 years. So that's another $55K in addition to his $76,000 as example here. And then from year 6 to year 10, the lender is investing that entire amount, which is $130,000 annually for the next 5 years. Now, the advantage of this, of course, is less money he has to put into it. The lender ends up contributing almost $1 million. Now, what happens at $1 million? Well, it's paid back around the 15th calendar year. And remember, going back to the idea of why the policy loan. When he pays back the loan to that lender in the 15th policy year, his account, assuming the investment is still growing and assuming there's an arbitrage there, he has an opportunity of still earning money that's actually been back into his pocket, because that money goes directly to the bank. It's out of the policy, but it's still earning, like that account value was never taken away. So in this particular example, initial death benefit, 2.1 million. Now, if he did pass away in the first year, he only owes that lender about 55K. So there's still a tax-free benefit that is available. This loan is being, and the policy is being used in a trust, and it is. And the reason why banks would do this, because they have the cash value of that life insurance policy. And if something happened to the policyholder, of course, the death benefit. So they really eliminate the risk because of how that cash value works. But that 65-year-old, we're looking at about $130,000 a year of tax-free income. So a little less than the first example, but also about a third of the income that had to be put out of his pocket to do that. And again, we're looking at a tax-free death benefit of 1.42%. So for those who are interested, please reach out and let me know about the hybrid model when you do set up your call. And then we can definitely send you some information and some more teaching ideas. There's a lot that goes into that. There's obviously a lot of risk. There's loan risks. There's different risks that we, of course, explain all those types of risks. So the main advantage is less out of pocket. You're using leverage of lenders to build wealth. Disadvantage is there's no access to capital in the first 15 years. And there's also, of course, I mentioned earlier, that interest rate risk. So again, we're looking at that policy loan being repaid in the 15th year for this strategy really to make the most sense. That means that money's being able to grow a lot longer. Now, the third study, for those that are worth more than $7 million, we do work with a lot of lenders that do premium financing. So the advantage is that, so for all this case study one, we're still using about the same amount of money. So in this case, you can see we're averaging about $75,000 in payments over those 15 years. But the difference is all of that is being funded by the bank, that $206,000. And the only thing in this example that we're requiring the policyholder to do is just make the interest payments. So these are approximations: $14,000 the first year, $46,000. And of course, that payment is always paying the interest every single year. And you can see by the last policy year that he's going to be making payments, there's a $139,000 as the interest payment. Now, there's most likely some extra capital that needs to come out of pocket for collateral. So possibly, in this example, I think there was anywhere between $50,000 and $100,000 that also had to be put up of personal collateral. So a little different than the hybrid strategy, but you'll see that the results here. So over those 15 years, about 1.3 million is being interest payments are being paid into to be paying back to the lender. And then the loan is also same example. It's going to be repaid in that 15th policy year. Now, there's other examples. If that person does not want to have income, they can let that policy loan still grow. They can make different arrangements, because then that they're allowing that death benefit to grow. So if you want to use premium finance to do a legacy play, there's a lot of really unique structures. But in this case, we're just showing it for income. So initial death benefit is 2.9 million. Again, if death were to occur, from day one, assuming there was no fraudulent results of the application, there is for those that don't know, there's a 2-year non-contestability clause that if anything happens to the policyholder that potentially was misrepresented on the policy, insurance carriers only have 2 years to prove that, the first 2 years. So in this case, that 60 to 90s withdrawal rate, $282,000. So we're talking tax-free of about $8.4 million. Again, he was only making interest payments. But look at this. There's still a potential $10 million at age 90. Now, again, we're using some assumptions that this policy is making a 6.5% return, which, we are showing you those projections, and some of these policies can go higher and they also could go lower. We can't control what the stock market does, but what we can control is that 0% floor. So that premium finance, the advantages, less capital out of pocket in the early years. We're using leverage to potentially build greater wealth, and we're looking at potential greater results and a higher death benefit and income stream. Disadvantage, just like the hybrid model, there's no access to policy capital for the first 15 years. Interest rate risk of loans. And again, typically most carriers, we have a couple carriers that go as low as 5 million. But typically it's between that $7 and $10 million range. So again, when you're making those appointments, let me know that you're really interested in the premium finance idea as well. So here's a comparison. Roughly $75,000. You could see the tax-free income, 148,000 for the self-funded. Assuming that was from age 60, there's still a death benefit. The hybrid model is only investing, so obviously 1.125 versus 380,000 over 5 years. The lender contributions, the initial death benefit, they're a little bit different there as well. But again, this is really where that tax-free income play. Now, this is at 75. This would look a lot better if they actually invested, similar to that 1.1 million. But again, it's going to be over those 5 years. There's still a tax-free death benefit in all these cases. And if you do qualify, premium financing, even in a high interest rate environment that we've been at in the last year or two, it can really be beneficial for those. And we still have investors that are doing this all the time. Again, you can see the lender premiums. Advantages here is interest-only payments, so it's less in the beginning. But again, these examples were still averaging about $75,000 a year. But that income stream has the potential of being a lot higher. Again, these are hypotheticals. These are not guarantees. We still have to have market participation. There's interest rate risk. There's a lot of risk. You definitely want to, when you get into any type of hybrid or premium finance and any insurance policy, you really want to make sure you're working a professional. I've been in the industry for 23 years, West Point graduate, Army veteran. So I love the opportunity. I've been selling life insurance for that amount of time. And for me, it's one of my passions. Okay, let's look at the next case study. We have a 44-year-old female. Her goal is to start tax-free retirement at age 61 or 60. However, she has $1 million. That could have been from savings. That could have been from an inheritance. That could have been sale of a property. And then she's also going to continue to invest $50,000 a year from year 3 to 17. So total investments are 1.7 million. Again, these are all case studies. I'm helping you kind of think out of the box, potentially things that maybe your life insurance or even a financial advisor you may be working with has not talking to you about, because most wealth managers do not talk about life insurance. So her initial self-funded policy is going to be worth about $5.1 million. Again, tax-free death benefit. But more importantly, that is also, again, remember, that can be used for a disability type of event. So if she cannot perform 2 activities of her daily living, she can access actually some of that death benefit for long-term care, which is really going to help sustain her family's wealth over generations, potentially. So in this case example, $350,000 per year from age 61 to 90. That total income is about $10 million. So remember, she put in, going back to that first slide, she put in 1.7 million. She's able to take out, again, if she lives till 90, this is the hypothetical examples we're using, and there's still a $4.2 million tax-free death benefit. So really, if you did the math, it's about, easy math, 2 million roughly she put into it, and she's getting back about 16, almost $17 million. So that's about almost between 14 and $15 million of gains. But because the IRS has the 7702 tax code, that comes tax-free. Let's look at the next case study. It's a 50-year-old male, has a goal to retire at age 65. He's in good health. Primary objective is tax-free retirement starting at 65. He's contemplating, has $1 million or $5 million lump sum investment to put in a year. And this could be a case, I have a lot of life insurance agents here in Florida that they also do financial planning work, and they've actually moved a lot of their wealth planning advisors into insurance policies because they love that 0% floor. So if you're worried about, where the stock market is at, that we're looking for, potentially a downfall at some point, insurance could be that safety net. So he's contemplating between either $1 million or $5 million is the example we're going to be used, and that's all going to be in the first year. Now, the way we're going to invest it, it's actually going to be invested over time to avoid what the IRS calls a modified endowment contract. So in this case, the $1 million is going to provide initially a $2.6 million tax-free death benefit, also access to long-term care, critical illness, any disabilities. That's going to provide a revenue stream of about $210,000 a year. Total income, $7.3 million, and there's still a tax-free death benefit of $1.6 million that's left over. Again, trying to give you some different ideas depending where you're at. I'd love to have that personal meeting with you. We will provide you a free analysis, understanding what you're trying to accomplish in our first call, and then we'll also go from there. But in this case, again, this is for case study 3, million versus 5 million. The 5 million example is a $13 million tax-free example. Age 65, that's going to provide him about $1 million a year. And for those of thinking out, like, how can that provide that when it's still projecting $37 million? Again, remember, it's a loan. When he borrows from the policy, his account in this example is still earning 6.63%. Even though he's borrowing out $1 million every single year, it still has the potential of earning interest during that time period. So at 6.63, we're looking at a loan rate of 5.7. So there is an arbitrage that's going to be there that he has the potential, and that's why that's really providing that. And again, tax-free death benefit at age 90. All these examples, we provide illustrations. An illustration is exactly what it is. It's a hypothetical. So let's look side by side. Million versus 5 million, 2.6 versus 13 million. 210 per year versus $1 million. Again, obviously he's tripling or putting an extra $4 million. But again, these are ideas when we're strategizing with our clients to help figure out what is the best solution for that individual. Here's our case study number 4. We got that 60-year-old male wants to retire at age 70. Preferred health. He wants to structure an investment of $5 million per year for 7 years. So total contributions are $35 million. Again, a lot of wealth managers probably are not talking about moving money out of their investments to put it into something like insurance, but let's look at the advantages. Advantages initially a $63 million tax-free life insurance policy. Also, he has access to long-term care. That's going to provide a tax-free income stream of about $4.3 million. And of course, with that larger number over that time period, assuming from 70, now we extended this one out to 100, his payments of that $4.3 million, making the assumption of that 6.63 interest credit and a policy loan of 5.7, is still providing $129 million of tax-free income over his lifetime. Now that could be gifted. They can give that to charities. And these are different ideas. Again, this is being self-funded. It also still, even though you've taken out all that money at age 90, I just showed there to keep all the case studies the same, there's still almost a $25 million tax-free death benefit. So you can see the advantages for this individual. And the really big thing is we took a lot of the risk off the table by going into an insurance policy where he never really has to worry about a 9/11 type of event happening or a black swan event happening and losing a significant portion of his assets. But if it does happen, he has the leverage of the insurance policy that he can obviously have access to that capital. Now, I know some folks on the call really hear about how do I create multi-generational planning? And this is off of IRS code 101A, is how death benefit is income tax free. Now, saying all that, there's still an estate and gift exclusion. So every individual has right now 13.9 million per person that they can leave without having to pay any state taxes. Combined for married couples, almost 28 million. However, once you're over a million, so if your estate's worth, in this case, about $30 million, you're going to be maxed out at 40% everything over those exclusions. So these multi-generational planning here we're going to be talking about are going to be ILITs, which is Irrevocable Life Insurance Trust, to be able to avoid that. So again, the 2000 with the big new big beautiful bill, 15 million per person, and that's going to be also adjusted with inflation. But again, $30 million is the max. So these next slides are going to be kind of showing you, okay, how do we keep the money that we've inherited, and how do we pass it on, whether it's to family members, whether it's to grandkids, whether it's your favorite charity as well, and how do we avoid to have that not being captured within the estate. And to do that, before we do that, we'll just talk about the annual exclusion, because one of the case studies is those individuals, for those on this call, you can start gifting $19,000 if you haven't already done that, per recipient, per spouse, per year. So if you have kids and grandkids, you can give them collectively each $38,000 a year as a gift, and that comes outside of your lifetime exemption. So this does not account, and this does not affect that next year, that $30 million as a married couple or 15 as individuals. So this first case study we're looking at is, we have a married couple, 60-year-old male and 59-year-old female. The focus is Irrevocable Life Insurance Trust. Their net worth is about $55 million. Their primary concern is they don't want everything over that exclusion to be taxed at 40%. So obviously a big deal. In this particular case that we were working with, the male was has standard health. So we end up putting the life insurance on the male. And what we're doing here, again, these are just showing you some ideas. They're using part of their lifetime exemption. In this case, $2.7 million over 5 years is being invested. And that can come from the husband or the wife's exemption, however they decide to do that, working with their attorneys. But in this case, we're creating now, I don't use the word guarantee often, but this policy does have a guaranteed premium. So as long as that 2.782511 million is paid for 5 years, it does come with a guaranteed tax-free death benefit that is now, because it's in a irrevocable life insurance trust, there's a lot of mechanics with that, but the very basics is the money gets donated to the trust. The trust is the owner of the insurance policy, but that takes $35 million outside of their estate. Again, this is just showing limits, what we're doing for this particular couple. Next case study, number 7, is we have a married couple, 61 male and 56-year-old female. They have 2 adult children in their 30s. They're worth about $20 million net worth. However, they still have time for their money to grow, and based off of some of their business dealings, that they really feel that they want to make sure they're planning now to avoid that state planning taxes. So by looking now, their strategy in this particular case is they end up putting the insurance on the 56-year-old female who was in perfect health. In this case, she had what we consider preferred plus ratings. So what they did was they actually did their annual couples gift exclusion. So they gifted, like I shared earlier, $19,000 per child, which is $38,000 for each child. So $76,000 per year was given to this irrevocable life insurance trust. And this example, they're paying $76,000 per year up till age 100. But look at this, guaranteeing tax-free $6.8 million that will be excluded from the estate. Again, remember, it has to be done in an irrevocable life insurance trust. And these are things that our staff and attorneys and advanced planning teams that we work with can assist with that. So, when you're making your appointments, make sure you're letting me know that you are interested in legacy planning and the ideas that we're talking about. So this is case study number 8. So this is a little different. We're doing some generational planning. They have 4 adult children, ages 32, 35, 38, and 40. Their goal is to leave a legacy to their grandkids. Now, they already have In this case, they, example, they could either give money to their kids or not. But in this example, they have the options. We can either, we have $1 million total they want to give to their grandkids. So they can put that in their will and their trust that $1 million comes out of their checking account and goes that, or they can look at using generational planning using life insurance. So all the insurable kids have various health classes. So in this case, the first option we're going to do is the 65-year-old said, you know what, I'm just going to get insurance on myself. I'm insurable. We did some medical exams. We found out, okay, he can get insurance on himself. So that's one option, is he can commits $1 million to purchase life insurance. We actually fund that over a 5-year plan to keep the tax advantages inside the life insurance. But you can see here immediately that $1 million turns into a $2 million death benefit that goes till 80. It doesn't start seeing growth until his 80s. But if he lives until he's 90s, there's a $3.6 million, remember, tax-free transfer to either his kids or his grandkids. Now, in this case, the reason he did it on himself was he was also a little worried about long-term care, medical expenses later on. So because he's the owner of this policy, he could still access that death benefit if needed being for long-term care. So there's some added value and added safety by doing option 1. Now, option 2, and this is something we did with families as well, is that instead of buying it on the family members, and this could be even, in this case, they want to give to their grandkids, they end up putting, and we can rearrange this based off a health class. So, but I wanted to keep it simple. So we're showing exactly $250,000 is going on each 4 children, and all the grandchildren are designated on their aunts, uncles, and parents' policy. So those 8 grandkids would all be listed on the 40-year-old female who is in perfect health or preferred health. We had a 38 male preferred health. You can see 567. The 32-year-old male, though, he was a smoker, but we're still able to get $775,000 of tax-free insurance on him, and a total of 5.98. So total initial death benefit, $2.3 million that we were able to initially from the get-go have it on the kids to give to the grandkids. Now, who owns these policies? In this case, we can have it where the grandparent still owns the policy, and then upon death, it actually would transfer over into the kids. If they're concerned about control, these can be put into life insurance trusts as well. So again, there's a lot of different ideas, but again, I'm trying to give you ideas of thinking that if you already hadn't done of thinking of these legacy plays. But here's the interesting part. So if each child, now again, these are the hypothetical part. If each child at their 70th birthday passed away, that's $9.8 million potentially that would be gifted to each of the grandkids. So again, in this scenario, every grandchild at a certain moment would be getting part of either mom, dad's, or aunt and uncle's policy. If they lived until they're 80, 15 million. 85, 19. Again, these are hypotheticals. This is considering there is some stock market growth. Remember, it does have that 0% floor, so there are some advantages there. And if they all lived until 90, that means that $1 million, he almost 25x'd that $1 million. Now, granted, that money was not given to the grandkids until they're probably in their 60s and 70s, if every of their parents and aunts and uncles all pass away at 90. But again, this is talking about dynasty and building generational wealth for generations. And one of my favorite proverbs is, a wise man leaves an inheritance to his children's children. So here's a case study comparison as far as on a legacy plan. So just looking at it, first off, we talked about that 60-year-old male, $13.9 million was funded over 15 years, $35 million tax free death benefit. We had the 56-year-old female who's going to take advantage of her and her husband's gifting exclusion of $76,000 per year, purchased a tax-free life insurance policy of $6.8 million. We have the legacy of the 65-year-old male. We funded that a total of $1 million, provided a tax-free $3.6 million death benefit. And then we also had, we were looking at those 4 children. again, we could split it up because we knew, for instance, the uncle or the son of a 32-year-old male uh, was uh, was a smoker. There might have been potential of shifting some of those assets to maybe one of the kids that have better ratings. So again, we've done that in the past. If there are some tobacco users in the family, tobacco typically costs a lot more. So we would work with you and your family to figure out what's most sense. Because remember, in this example you're shown, now you can decide however you want to structure it, but we had every grandchild listed as the beneficiary of every single one of those policies. And of course, that ultimately generated about $24 million in tax-free benefits. So what are the key takeaways? Tax-free wealth strategies. We looked at tax-free loans, how to utilize your cash value plan. So those are things that you really want to make sure you're working with a professional, because if you're borrowing too much money earlier on and you're not paying it back, it could really be detrimental to your policy long term. So those are things you really want to look at. We did talk about triple tax advantages, benefits of the tax deferred cash value, tax-free access to funds using policy loans, and then ultimately the tax-free benefits to beneficiaries or your charity or nonprofit of your choice. Robust estate planning. There's significant tax-free inheritance from your heirs. There's ways of gifting it. Things we didn't talk about today, which we easily could have, would be is that we do work with charities, nonprofits, 501c3s, where you donate the money to them. So for instance, if you're donating right now let's say you're donating $200,000 a year right now to a church or charity of your choice, you can donate that $200,000, and then we can talk to that charity about having them putting maybe $100,000 or $150,000 of premium payment to a life insurance policy that would be gifted to them. So you get the advantage of taking that charitable deduction now. They get the advantage of building a legacy long-term. Again, love to talk to you if you're interested in charitable giving strategies. Make sure when you're setting up the call, talking about that. But the application, these strategies, they can be highly effective if it's used properly. This was a very quick one over the world. Obviously, I would spend more time working with you. I'm also available to work with either your parents or even your children to talk about generational wealth planning. So please use me as a resource for sometimes those awkward conversations that you don't like to have with your kids or even with your parents. Use a third person like myself to be able to navigate, and what does that look like? And again, long term, there's just be some ideas. So what are some next steps? Initially, for those who are going to want to set up a call, it is year end, so there's a lot of shortness on my calendar. So please take advantage. My information is in the chat right now. I'll make sure for those who just came on board, I'll post it again. Please use my scheduler on there. We'll initially do a 15 to 30-minute phone call initially to get that kind of understanding what you're trying to do. Because most importantly, once we get that financial data, we want to do that assessment and figure out, number one, does this plan even work for you? How is your health? We work with carriers where we can get that initial exam done, taken care of by some cases. Sometimes we most likely need to get a nurse, but in some cases we don't, depending on the size of the policy, to figure out what is your health class. And then we really start looking at that strategic selection. How do we plan? What are our goals? Are we looking for tax-free income? Are we looking for estate planning? Are we looking for a combination of both, but also want to make sure you have money for long-term care? Or are you just looking to try to avoid the estate gifting exemption of that $30 million next year, and looking at just wanting to fund that money and move it outside? So there's a lot of strategies, and ultimately it would be implementation and funding. So, we're right at 45 minutes. I thank you everyone for your time today. I really love to be able to partner with you. I'm going to stop the recording right now, but if there's time, for those that are listening, my phone number is 813-807-0391. You can also reach me at my website at www.123-lifeinsurance.com. Feel free to schedule a private, no obligation consultation with myself and our team. Love to be able to help and with you, but at this time, I'm going to go ahead and stop our recording, And I do see there are a couple of questions. So let me go ahead and stop the recording.